Welcome to Loup TV. I'm your host, Gene Munster, joined by Loup's David Stockman. For those of you who don't know David, David and I work closely together and research, invest in, and try to predict where real estate tech is going. That's one of the verticals that we operate in. It's been a big week for real estate tech. Loup may make investments within real estate tech, and the companies that we're talking about today include Opendoor, Zillow, Redfin, and Rocket Mortgage, also Blend Labs on the financing side. And so bring in David. Actually, before I bring you in, David, just to kind of recap what happened, the highest levels, these companies had great quarters. In the case of Open and Zillow, both of them met high expectations. I think those were pretty well telegraphed based on some of the data that came out. But as a surprise, they raised guidance for September. In Zillow's case, they raised their iBuying segment by 50% versus where the street was at. In the case of Opendoor, they raised their guidance by 25%. Redfin also had positive results and inched up guidance. When you put it all together, it was the tale of two cities in terms of how these stocks reacted. On one end, you had Open up 25% on the report. And on the other hand, you had Zillow and Redfin, both companies, since they have reported, are down almost the exact same amount, about 13%. And probably not a mystery there. We'll talk about that gap in a minute, what explains that discrepancy. But before we do that, I'd like to bring you in, David, as you have studied, basically spent the last week here looking at these companies and digging into the details on them. What do you think is the biggest just takeaway, the highest level takeaway from June results related to these real estate tech companies?
For me in the iBuying space, so this is in particular Zillow and Opendoor, Redfin also has a small iBuying operation today, is the success they've had in acquiring homes in what is probably the hottest sellers market that we've had in recent memory. And there's a perception amongst people in the iBuying space that it's only a good option for distressed sellers. When the market's this hot, it's a no-brainer to put it on the market, get into a multiple bidding war with buyers. But you're seeing consumers just generally a secular trend towards transacting online. And then they're also valuing this convenience and certainty piece very highly. And so I think that bodes well for them, especially if the market cools off or even turns over. Uncertainty is going to increase, and I think the value proposition for iBuying becomes even clearer.
So to put some finer points on that is that sequentially, you can't really look at the year-over-year numbers on these because it was so messy a year ago, but sequentially, Zillow increased the number of homes that they purchased by 100%. They doubled it from March to June. In Opendoor's case, I think it was 135% sequential increase. So clearly something's going on, something bigger is going on. And it is important. That was my takeaway as well. I think that the theme of iBuying is moving in the right direction. It's still minuscule. We're talking about sub 1% of homes in the US are sold this way. But it's when things take off, and we've seen pattern recognition around this for 20 years, when you start to see these accelerating numbers in what is a difficult environment, like you described for iBuying, because the regular market is so hot. It really speaks to consumers wanting a different option. And so agree with you on the takeaway. There is also the piece around, the sustainability. What do you think happens? Of course, that question came up, as it has in every tech earnings call this period. How sustainable is this? What do you think happens when we start to see the residential real estate market undoubtedly cool off in the next 1 or 2 years?
I think it's going to be a perfect test for the iBuyer model, which is based on a belief that algorithms, computers can one day, if they aren't already, be as good at predicting a home sale price as humans are. And so one of the risks with iBuyers that people flag is that they're overpaying for homes. And we saw Opendoor in particular, but also Zillow, be more aggressive with their offers to acquire inventory. And there's a risk that they overpay when the market cools and they have to get rid of inventory. But I think it's going to be a perfect test as to whether the amount of data volume and scale they have that comes with experience will be able to adjust their pricing algorithms to at least stay pace, if not stay ahead of the market, because that once you get that scale data, they're going to have advantages that individual realtors or home sellers don't have.
Yeah, it would seem to me that ultimately a cooler market is a tailwind. It runs counter to how investors are thinking about this. And maybe that's a segue into why I think there was a discrepancy here in the results. The profitability on a per home basis for Opendoor, which again was up nicely after they reported, was higher than it was for Zillow in the iBuying segment, about twice as high. However, that was aided by some of the price appreciation, which isn't sustainable. And I think as you kind of look at the drop in Redfin or Zillow, I think just the broader real estate tech market, Blend Labs, for example, down 8% in the past week. And they do essentially rocket mortgage in a box for banks. But I think if you put that together, what it says to me is investors aren't paying as much attention, for the most part, for real estate tech in the results and the theme around what's going on with iBuying. And it's understandable because they're looking more towards what's going to happen next year, which is going to be a cooling market, residential market, and to put to the test, as you said, to these business models. And for me, as investing in this space, it seems that they almost need to show investors over the next year that these models are in fact going to deliver profitability and deliver continued adoption of iBuying in a difficult market. And so time is going to have to march by. They're going to have to continue to report some quarters along that front, I think, to get rewarded. And ultimately, it comes down to, do you believe, I guess, in the theme of iBuying and simplicity, and historically that has played out. I want to end here on, David, love your take, just if you think about these companies, and let's kind of zero in for a minute on probably the ones that get the most attention, which would be Zillow, Opendoor, and Redfin. Can you love to hear what you think is kind of the greatest strengths of each of them, and what you ultimately think are the biggest weaknesses?
So we'll start with the elephant in the room, which is Zillow. And I say that because they dominate the top of the funnel. They have at least 200 million monthly active visitors to their site.
230, I think, last quarter.
Yes, right around 230, which is an enormous number. It's most of the US that are in the home buying age are checking Zillow. And so I think for them, that's their strength. And the test is whether they'll be able to leverage this brand awareness and trust into actual transactions with consumers.
Let me jump in there too before we go to Opendoor. Is I would add another strength or a decision that they've made is to continue to work with real estate professionals. We picked up on some promotional activity they've had to get real estate pros to spend on advertising for lead generation with them, give them some discounts, promotion that runs to the end of August. And so it's a very different approach than some of the other companies have taken. Zillow wants to kind of embrace, at the same time compete with the industry. I think there is another X factor that has been working against Zillow. They have this shelf offering that they took out last December, $1 billion. They said that they were going to be selling. They have sold just over half of that. That was in the December quarter. The average sale price was around $170. The Zillow is now below $100. And so they have not sold over this year. And it does kind of create for some investors, a psychological cap on the stock. I think that ultimately it's a good policy to have in place. A shelf, every company should have one, because if the stock just spiked up out of control, it's a fast way that the company becomes a meme stock. The company can capitalize on it, as they should have a share buyback program, which Zillow currently doesn't formally have a buyback program. But I would say if they could just tighten up that capital allocation policy, I think it would go a long way to instilling some confidence. Back to you, David, on Opendoor.
Yes, for Opendoor, their biggest advantage, in my opinion, is just their scale and their iBuying know-how. They've been in this space the longest as a pure play iBuyer, and they're in the most markets in the US. I think 41 they reported, compared to Zillow, which is about 25 markets.
And remind us how many homes that they purchased versus Zillow in the June quarter.
Opendoor purchased around 8,000 and Zillow was just under 4,000. And so with that type of scale comes know-how and just more experience. And we've seen that just in some of our own internal tests of the product, that Opendoor seems to be at a different level today than Zillow. And it's up to Zillow to try to close that gap over time.
One thing on the closing of the gap, you found this through your daily checking of all these sites, is that Zillow has lowered basically their take rate to sellers from about 8% in the June quarter and before, and starting in the September quarter, so early in July, they lowered that to about 5%, which is now in parity with what Opendoor is. And so I'm curious to see how their buying activity compares, given now that their rate cards are more similar. On to Redfin.
For Redfin, I think their advantage is they have strong top of funnel traffic as well. It's about 45 million monthly unique users.
I guess it's all relative, because that's not very strong when you look at Zillow at 230.
Correct. But I think any other company but Zillow would probably be pleased with the 45 million a month. So they have strong web traffic, and their ability to book tours instantly on demand for buyers is probably their biggest advantage, especially right now when buyers are eager to get into homes, and a matter of a few hours can be an advantage in being a competitive buyer. So I think if they can continue to push that offering, which increases their conversion rate for agents and should improve their margins, this is important. And then over the next year, for Redfin to try to connect buyers directly to sellers, they have a nascent offering, Redfin Direct, at which buyers can make offers without an agent. I think that ability to match directly is also Redfin's one of their advantages that gets overlooked.
So a little bit of Goldilocks here is that you got really the iBuying powerhouses with Open and Zillow, and then you have Redfin just going after it with basically a discount brokerage model, then a little bit of iBuying on the side, sprinkled on the side. When you put it together, comes out, what does it spit out to us is Redfin's got about a $6 billion market cap, Opendoor about 10 billion, and Zillow about 25 billion. I think that whoever cracks this code, this is multi-trillion-dollar TAM, just all the transaction value around this. It's going to be, collectively, these companies should be generate more market cap in the next 5+ years. And so it's an area that we're going to be continuing to ride on. Thank goodness I have you, David, to work with. Appreciate all of your insights day in, day out. And on today's episode of Loup TV, on behalf of David and myself and Loup TV, bye for now.